Okay. Good morning, everyone. Today, long session, 6 hours. I will be taking you through two standards over today and tomorrow. That is, the first one will be Ind AS 40, which deals with investment property. And the second one will be Ind AS 105, that deals with non-current assets held for sale and discontinued operations. So, the first standard for the day, that would be Ind AS 40, which deals with investment property. So, what do you understand by the term investment property? If I look at a simple definition, a property that is held for investment qualifies to be an investment property. A property that is held as an investment qualifies as an investment property. The standard defines investment property specifically to mean any property which includes building or land or part of building or both. So it gives a very holistic definition that it could mean land, it could mean building, it could mean even a part of a building, or it could include both land and building together, provided the purpose is to earn rentals. The purpose is to earn rentals, or you are holding this investment property for the purpose of capital appreciation. You are holding this investment property for the purpose of capital appreciation. So, simple things, property held for investment, it could be land, it could be building, it could be part of building, or it could be both. And it is held specifically for earning rentals or for capital appreciation, or it could be for both. That means rentals as well as capital appreciation. That is rentals as well as capital appreciations. The standard also proceeds to continue with the definition by saying that investment property cannot be the property that is held for production or supply of goods or services. It will not be the property that is held for production or supply of goods or services. Now, production or supply of goods or services means we are talking here about property, plant and equipment, which would be covered under Ind AS 16, which would be covered under Ind AS 16, property, plant and equipment. It also, the definition also says that property that is held for administrative services, property held for admin services. Let us assume you have an office building for yourself. Let us assume you have an office building. You do not actually provide any services or supply goods from there, but that is your administrative office, that is your corporate office, your registered office, where all the administrative work is being handled. Now that is being used by the entity for itself. So therefore, it will not be classified as investment property, but that will continue to remain as property, plant and equipment. And finally, it concludes by saying that even the property that is held for sale in ordinary course of business. Sale in ordinary course of business. So this would be which type of property? This would represent an inventory. This would represent an inventory which would be dealt with under Ind AS 2. So a quick recap of the definition of investment property. It would be property which is land, building, part of building or both land and building together, which could be held by the owner. Held by the owner, that means the ownership is with me, or it could be held by the person as a right of use asset. It could be held by the person means in this case we are talking about a lessee. It could be held by a lessee as a right of use asset. So whether it is my own property, whether I am owning it in the capacity of a lessee as a right of use asset, what is the intention of holding this property? If the intention of holding this property is to earn rental or to hold it for capital appreciation purposes, or both, and it is not going to be held for production or supply of goods or services or administrative services or employee occupied property or sale in the ordinary course of business, then these properties would be classified under the category investment property, and the objective of investment property is to prescribe accounting treatment and related disclosure requirements for investment property. Accounting treatment will include measurement, recognition, presentation and disclosure. So all these requirements would be discussed under Ind AS 40. Okay, I hope you people have downloaded the study material from the ECPL website. I'll just give you a minute so that you can download the material from the ECPL web page. Because I will be having problems in the future, which we will be discussing now. So I need you to get the material with yourself. So just take a minute, download the material from the ecpl.live website. Okay, so I hope you would have downloaded the material. Please download. We shall now continue with the further discussion. Okay, so now what is exactly covered under Ind AS 40? Okay, what is going to be covered? So now we will be discussing the scope para of Ind AS 40, which is dealt with in para 2 and para 4. You don't have to remember the para numbers for your examination, but suppose you have an inclination to read the bare standard, then at that point of time you can refer these para numbers and notice that the scope is mentioned in that. So in the scope, we would be having applicability, what is covered, and we would be having exclusions, what will not be covered. Any scope paragraph will have these 2 points. What will be discussed in this standard or what will be covered by this standard, and what will be excluded from this standard. So in this case, the applicability is recognition, measurement and disclosure of investment properties. And we have already seen the definition of investment properties. And then what is excluded from the purview of investment properties? It would be, there are 2 exclusions. The first one is biological assets. The first one is biological assets. So what is biological asset? You will have to refer to the next standard after Ind AS 40, that is Ind AS 41. Biological assets means any living animal or a plant. Now that is also having a fair value model under Ind AS 41, but it is being dealt with in accordance with Ind AS 41 requirements. And you will also have to refer to Ind AS 16, where there is a discussion on bearer plants, So these elements, biological assets, these elements are excluded from the purview of investment property. Investment property has given a very exhaustive definition. It is not it is not going to be an inclusive definition as such. It only means to say it talks about immovable property. You could be the owner or you could hold it as a lessee. You could hold it as a lessee as a right of use asset. The second exclusion is talking about mineral rights and reserves, such as oil, natural gas and other similar non-regenerative resources. So our scope applicability and scope exclusions are now defined separately. Okay, so this talks about the scope paragraph. We exclude biological assets and we exclude mineral rights, reserves such as oil, natural gas and similar non-regenerative resources. The question that arises is, why do I need a separate standard on investment properties? And the second question that will now arise is, was it there in the past regime? Was it there in the previous regime? In the previous regime, there was a standard AS 13 that dealt with investments. In investment standard, there was a passing reference to investment properties. If you look at the definition of investment properties, it is outlined in AS 13. And even as a passing reference, they have given the treatment of investment properties. So this was covered as a passing reference in AS 13, not as a separate standard. Under the Ind AS regime, we have a full-fledged Ind AS 40 that deals with investment property. Now the question arises, why was a separate standard required for investment property? What is the objective behind introducing a separate standard for Ind AS for investment properties? I'm just drawing a simple T-form balance sheet, although you don't prepare it under the Ind AS requirements, but this is just for our understanding. A simple T-form balance sheet and a simple T-form P&L. This is just for explanation purposes. You don't prepare a T-form balance sheet. Okay. So under your balance sheet, normally you would be having first item as non-current assets. You would be having your item as non-current assets. In non-current assets, you would be having property, plant and equipment. Now every item in the balance sheet would be having some nexus with my profit and loss account. So now this PPE will be generating income in the form of revenues. It would be generating income in the form of revenues. Revenues from contracts with customers, that is covered under Ind AS 115. So this PPE generates income in the form of revenues. Investment property would be generating incomes in the form of rentals. It would be generating incomes in the form of rentals. There is a need to segregate revenues and rentals. Why? Because revenue talks about contracts with customers, and customer means those parties who buy the goods and services of the entity, which is the ordinary output of the entity. So what are the general output that is going to be purchased by these customers? That is going to be covered under Ind AS 115. But rental income does not meet the definition of revenue strictly speaking, because it is not the ordinary output of the entity. There is a property, you have given it on rentals. If it is a separate entity dealing only in rentals, that is a different issue. But we are talking about entities which could be a manufacturing entity, which could be a service providing entity, having other main lines of business, but this is just an investment that is held for earning rental. So at this point of time, these two revenue flows will be shown separately in your statement of profit and loss. Now when these two flows are shown separately, naturally the question arises, from where does this revenue come in? From where do these rentals come in? If they were shown under only a simple property, plant and equipment category, that point of time, the analysts, the users of financial statements would find it difficult to understand what is the value of property, plant and equipment which is giving me revenues. What is the property, plant and equipment that is giving me rentals? So therefore, Ind AS 40 was introduced, which now divides the property, plant and equipment and investment property. And now I can tell what is the PPE that is contributing to the revenues, what is the investment property that is contributing to the rentals. I can also come to know what will be my fixed asset turnover ratio, a ratio that you have studied in your intermediate levels, which tells about the efficiency of the operations of fixed assets, how efficiently the entity is using its fixed assets. This gives a truer picture, and investment property rentals give a true picture of the return on the investment property. So this nexus is important. Therefore, Ind AS 40 helps us to achieve what is the faithful representation concept that was outlined in the conceptual framework for preparing and presenting the financial statements in accordance with Ind AS. Okay, so this was the reason why we have a separate investment property that is covered under a separate standard Ind AS 40. I just give you 10 seconds. If you have any doubts so far, please tell me. Okay. Okay, so that is clear. Now let us proceed to the next discussion. The next discussion will deal with how or what are the differences between investment property and owner occupied property. Investment property and owner occupied property. What is this? Investment property, we have discussed the definitions in detail. The definition is land, building or both. Land held as an owner. So I could either own the asset or I could be a lessee And whether I own or whether I take it on lease, I am the lessee. The purpose is the same. It is to earn rentals or it is for capital appreciation or it is for both. In other words, my investment property represents those assets which are generating cash inflows which are largely independent from the other assets of the entity. Let us contrast it with owner-occupied property. Owner-occupied property could fall either under Ind AS 16, or it could fall under Ind AS 2, inventories, when I am holding the inventories to sell in the ordinary course of business, or it could be Ind AS 116. It could be Ind AS 116 when I give the assets on a finance lease. When I give the assets on a long-term lease, this would be Ind AS 116. So these three categories represent owner-occupied property, and the purpose in this case is it is either for sale in the ordinary course of business when it becomes my inventory. It could represent property, plant, equipment used for production or provision of services or for my administrative purposes. Now look at these categories of assets. Look at these assets. If I look at these assets, my property, plant and equipment, my inventories, they do generate cash flows. But these cash flows are not largely independent of the other assets in that unit. You will have to make use of other assets as well to generate the cash flows. Let us take an example. Ind AS 16, I manufacture goods. Now when I manufacture goods, the goods are there. They will now be transformed. They will now become my inventories. And now I am going to sell. So this Ind AS 16 is dependent on the saleability of my Ind AS 2. That means on the saleability of my product which is covered under Ind AS 2. So there is an interdependence of assets which is going to be involved. Further, the products which I have produced, the labor, the material, everything which is there, they will also have to be accounted, for which I am going to need the services of my administrative center. So my machinery, my inventories, my administrative centers, my human resources, all these items put together are required for me to generate the cash flows. So here there is a wholesome utilization of the assets. They are not largely independent items which generate cash flow, but they have to be combined with other assets to generate a cash flow. Contrast it with investment property. A building is there and you give it on rent. You do not have to make any other effort, as in you do not have to include any other elements in such a detail as is required for investment property. So therefore, an investment property can also be identified by the fact that it is an asset which generates largely independent cash flows of the other assets of the entity. So this is the major thing that differentiates my investment property from my owner occupied property. This is the major difference that distinguishes my investment property from my owner occupied property. Okay. So now your textbook, I have picked up some examples directly from your study module. There are a lot of examples which are given. All of them are necessarily relevant to our discussion. So I will discuss these examples with you one by one, and then we will proceed to analyze why it is an investment property, why such case would not be an investment property. So the first case would be land held for long-term capital appreciation. Very clear, land is held for long-term capital appreciation and it is not held for short-term sale in the ordinary course of business. So long-term appreciation, not for sale in the ordinary course of business. So when this is the case, okay. Shivagami from Tamil Nadu, sir, if any income from two assets which are same, how to segregate in case? Okay, we have an ability to split, so that will come later on. So I will be explaining that in a while from now. Srinivas Reddy, if the investment property from Bangalore, after that the question has not come in complete state. So please clarify, Srinivas, what is it that you want to ask? Manali, board is not visible. Please explain this again. I understand. Please explain this again would mean investment property versus inventory or owner occupied property. So investment property generates cash flows which are largely independent of the other assets. In other words, let me take an example of a company. I'll just drop this for the time being. We'll discuss the examples. I'll just clarify their doubts. Let us take an example of a company A Limited. Okay. In the case of a company A Limited, it is having a property which it gives on rent. At the same time, it is having a factory building wherein it carries on its operations. Now, this property which is given on rent, is there any other effort that the entity has to make to generate cash flows? Is there any other effort that the entity has to make to generate cash inflows? Or does it require any other asset to generate cash inflows? And the answer to that is no other asset is required. This stand-alone property only will generate me the cash flows. These cash flows which are generated, they do not depend on the factory building. They do not depend on any other asset. So this is clear when we are talking about largely independent cash inflows of the other assets of the entity. As compared to that, let us now talk about factory building. When we talk about factory building, here I am using property, plant, equipment. These items convert raw material to inventory, and these inventories will generate the cash flows. So now in this case, I have a factory building which does generate cash, but does it generate cash independently? The answer is no, it does not generate cash independently. For the factory building to generate cash, I need to install I need to install machinery. I need to install some equipment. So those assets will be utilized. Now factory building is utilizing the services of property, plant and equipment. They work hand in hand. So factory building with property, plant and equipment. The property, plant and equipment converts my raw materials to inventory which can then be sold. So this is an asset, PPE is an asset, inventory is an asset. All these things put together are generating my cash flows. All these things put together are generating my cash inflows. So this cash inflow generating entity, which is my factory building, is not generating cash inflows just because it is a factory building, but only when I use it in conjunction with the property, plant and equipment. When I use it to manufacture the inventory, only then it is generating the cash inflows. So this cash generating unit is making use of other assets within that unit, which is not the case in the case of investment property. Investment property, there is a building, that is enough. It will start generating rentals. If you are holding it for capital appreciation purposes, just hold it and keep it. My capital appreciation will take place. So this is what is the distinction between independent cash flows which require the use of more than one asset. Okay, so I hope Manali, I have addressed your query. And then Srinivas has asked, if the property held for investment initially given on rent, but later in the middle of the year or after 1 year, owner himself started production of services, how the investment of this asset, how the treatment of this asset will be considered. Srinivas, this topic will come in the course of discussion when there will be a change in the investment property. Okay, we will be covering that towards the closure of this standard. We will be discussing what will be the treatment when investment property becomes owner occupied property, and we will also be discussing what will be the treatment when owner occupied property becomes investment property. So I will just park your question until I reach that part. Okay, but it is a part of the standard. We will be discussing it. Okay. Now, I think I have another question that is coming in. Just a minute. Why this standard separately introduced from property, plant and equipment, that is Ind AS 16? I think I have already explained this. Challa Purushottam from Andhra Pradesh. It is giving the users a better understanding. Property, plant and equipment is normally going to be utilized for generating my revenue from operations. That means sale of goods, sale of services. Therefore, I come to understand, I come to know a better picture of my fixed assets turnover. How efficiently I am utilizing my property, plant and equipment. As compared to that, investment property generates rentals. So when I segregate the investment property from my property, plant and equipment, I am holding it for investment purposes. So my return on investment, this I will come to know clearly as a user of the financial statement. So therefore, this standard had to be introduced and segregated separately. It is not just a part of this regime, it was there in the earlier regime as well. It was there in the earlier regime as well. So therefore, in the earlier regime, separate standard was not there. It was a part of AS 13 as a passing reference. But now it has become more clear because there is a separate standard attributed to it. Okay. So Manali is clear now. And then Srinivas, I have told you. Challa Purushottam, I have also addressed your query. Okay. So investment property versus owner occupied property is done. Let us now look at some cases. These cases are there in your study module, but we will be discussing the same cases. So the first case, land which is held for long-term capital appreciation. That means you are holding on to this land so that the value of that land will appreciate, and maybe in the future when you find that the land value has sufficiently appreciated, you may want to sell that at a distant future. It is not in your ordinary course of business, but you want to hold it to get the benefits of capital appreciation, rather than in the ordinary course of business, rather than sale in ordinary course of business. So capital appreciation, yes. Sale in ordinary course of business, no. So clearly this comes within the definition of investment property itself. So therefore, this case of a land held for capital appreciation is an investment property. There is no doubt about it. Let us now come to the next example that is discussed in your study module as well as this presentation. Land held for currently undetermined future use. Undetermined future use. I purchased land today, but I am not aware of what I am going to use that land for. Okay, I have just held it. It could either be for rentals, it could either be for capital appreciation, or in the future you may use it to build a factory building to carry out your operations. But as on today, when you purchased it and when you have held it till the end of the reporting date, you are still not clear why you have purchased this land. You had some cash, so probably you invested in acquiring this land. So this land, which is currently having an undetermined future use. I do not know what I'll do in the future. I had cash, so I invested. So your intention today is to park the funds in the form of an investment. Your intention today is to park the funds in the form of an investment. And accordingly, the standard tells this will be covered under Ind AS 40. This will be covered under Ind AS 40. Look at the objective. No company makes a purchase of an asset until they do not know how to use. That could be one objective. The second objective is the company is having additional liquidity. The company could be having additional liquidity. It wants to invest it somewhere. It wants to invest it somewhere. So what the company did, it found a piece of land. It has purchased it. Today I do not know what I will do with that land. In the future anything may happen. But look at the intention of the company today. As of now, do I know what I will do with this land? The answer is no. So probably you have purchased this land because you had additional liquidity. So therefore, it will be regarded as an investment made and it would come under the definition of investment property. I hope the first two cases are clear. Okay. Alright. Now, I'll address your queries because what happens, you just keep on writing your queries. I will address them as and when my discussions get over. Okay, so that important thing is I need to complete the standard. Okay, both the standards. So undetermined future use, investment property. Now, a building that is owned by the entity and leased out under one or more operating leases. Okay, so I am owning the property. A Limited owns and later on gives it on lease. Which lease? An operating lease. Although you don't have an operating lease, finance lease in today's terms, once Ind AS 116 has been introduced. Once Ind AS 116 has been introduced. Ind AS 116 has come, we talk only about leases and then short-term leases we discuss under Ind AS 116. Right now you take operating lease to be a short-term lease. You take operating lease to be a short-term lease. So I have given this property A Limited to somebody for a short-term lease. So your intention is to earn rentals. So it will be classified as an investment property. It will be classified as an investment property. The next case is interesting. A right of use asset relating to a building held by the entity and leased out, held by the entity and leased out under one or more operating leases. Okay. So A Limited now does not own this. A Limited does not own this building, but rather it is the owner of a right of use asset. It is the owner of a right of use asset in that building, which is now being given on lease, which is now being given on a short-term lease. You got the asset as a lease. It is probably meets the definition of a lease. So you have to recognize the right of use asset as well as you have to record the corresponding lease liability. So this right of use asset is now there in your balance sheet, right of use asset. That right of use asset is enabling you to give the building on a short-term lease. So you are making use of that asset which you have obtained on lease for a further lease. So this could be something like a sublease. This could be something like a sublease. At that point of time, not the building I do not own. I am only the owner of this right of use asset. This right of use asset will come under the purview of Ind AS 40, that is investment property. Okay. Next, right. Now, next we have a building that is vacant. Okay, there is a building that is owned by the entity, but it is vacant, held to be leased out. So the important word is to be leased out under operating leases. To be leased means it is talking about future. But intention is what? To be leased out under one or more operating leases, which means short-term leases. So what is your intention today? Your intention is to generate income by way of lease rentals. Your intention is to generate income by way of rentals. It meets the definition of investment property. It will be classified as an investment property. And finally, the last case that is there, property that is being constructed or developed for future use as investment property. Today you are constructing a property. So as on today, it is a work in progress. As on today, it is a work in progress. Now this WIP property, you are constructing to use it as an investment property in the future. To use it as an investment property in the future. So therefore, this WIP property, even when it is under construction, will be classified as an investment property and not under not under property, plant and equipment. So these are some of the cases which are given in your study module about investment property. The explanations are clear what I have discussed. If you have any doubts, please mention that. Okay. I will just be addressing your queries now, whoever have asked. Okay. Now, Challa Purushottam has asked 3 questions. Sir, if my factory premises used for another SBU strategic business unit, can we say that the asset is it my investment property? Now it depends how the strategic business unit has been formulated. If it is formulated as a part of my own operations, yes. So therefore, I am having 2 divisions. A Limited is having 2 divisions, Division 1, Division 2. In this case, A Limited is giving it to Division 2, a strategic business unit. That point of time, it will be owner-occupied property. But if the SBU represents a separate subsidiary, A Limited's wholly owned subsidiary is there, and that wholly owned subsidiary, to that wholly owned subsidiary, A has given the investment property on lease At that point, what will be the treatment? This will be there in the future, in the next couple of slides. You are having many questions. I am noticing from this discussion that we are having. You are having many discussions, the answers of which will be covered in the course of the deliberation on Ind AS 40. Okay. So my request to you is, keep your questions. All of them are genuine questions. I am not going to, not answer those questions. But I just want you to know that many of your questions are a part of this standard. They are a part of this standard. I will be discussing this. I will be discussing them for sure. Okay. Challa Purushottam. Okay. My video is getting blurred. Kindly correct. Okay. I'll just check it up. Just give me a minute. Challa Purushottam has asked, can we say investment property as non-current fixed assets? Absolutely, Challa, that is the right one. You have to take it as non-current assets. It will appear in your balance sheet under non-current assets, but as a separate line item and as investment property. Okay, and then please explain what are the differences between lease and rent, because these words are used interchangeably. That will be covered under Ind AS 116, which deals specifically with leases. Okay. So normally when I use the term short-term lease, lease is less than 1 year, and that would mean lease and rent is one and the same. So for my discussion today, when I use the term short-term leases, it would mean rental incomes, it would mean leases. Today I am not discussing on Ind AS 116 leases, which covers the right of use asset as a major part of its topic. Okay, so that is not the lease which I am talking about. I am talking about lease and rent, which are interchangeable. Okay, that means short-term lease. Okay, I'll just correct the video, Jitin. Just give me a minute, everyone. जय सर, वीडियो ठीक है? जय जय, वीडियो ब्लर तो नहीं है ना? ओके ओके, फाइन, थैंक यू. I think that is rectified, Jitin. I hope it is clear for you. Okay, next. Let us now proceed to discuss other examples. Examples of not an investment property. Which investment properties are not, which properties cannot be classified as an investment property? Please pardon me for the language. Properties which cannot be investment property. Property which is intended for sale in the ordinary course of business. So let us assume I am a real estate developer. I am a real estate developer. Now, in the case of a real estate developer, my intention will be to purchase the property for use, for sale in the ordinary course of business. For sale in the ordinary course of business. Real estate projects do not normally get complete within 1 year. They normally extend to more than one financial reporting period. So the example tells intended for sale in the ordinary course of business or in the process of construction or development of sale. So real estate developer, it could be completed units. Completed units. Okay. Flats are complete, occupancy is received, your intention is to sell it. It is your ordinary course of business. It will be classified as inventory. It will not be classified as investment property. Let us assume project is not complete. Project is in progress. So this WIP, the intention of this WIP, future, what will be the intention? Future will be to complete and sell these units. That point of time, this WIP will fall under inventories. It will not fall under investment property. And then in the process of construction or development. So suppose you have a land which you are in the process of developing it into plots for making a sale. You have land, you are in the process of converting it into plots for sale, and you are a real estate developer. So at that point of time, they would meet the definition of inventories. They would meet the definition of inventories, not investment properties. So therefore, for real estate developers, it becomes kind of difficult. I will tell you why it becomes difficult. Because as a part of their business, they are holding lot of immovable properties, land, buildings, WIPs. They are holding lot of these properties. So now as my as the entity that is presenting its financial statements, it really becomes difficult to identify whether my property is an investment property or whether it is an inventory, because both appear to be the same. So at that point of time, what do you need to check is, for a real estate developer, you need to go to the company formation documents. That is your articles of association, memorandum of association. Okay, I'm not so much of an expert in company law. Okay, so in these company formulation documents, you would be having the objectives behind which the company was created. What is the activity that the company proposes to carry out is discussed here. The principal activity. If it says, it talks about, constructing and selling properties, and the business is renting it out. At that point of time, renting will become a normal business activity for this company. Renting will become a normal business activity for this company. Why? Because the renting activity, when you give your buildings on short-term leases to the customers, those customers will meet the definition of customers under Ind AS 115. They are the recipient of your services which you provide in the ordinary course of business. They are the recipient of services which you provide in the ordinary course of business. And therefore, at that point of time, those properties which are given on rentals will not be recognized as investment property, because now that becomes your regular activity. Now that becomes your regular activity. And when it becomes your regular activity, it will come under Ind AS 115. So it will not be investment property. It will be your regular property, plant and equipment, or inventories as the case may be. Okay, so Chala Purushottam, you had asked a question about real estate developers. You had asked a question as of a real estate developer. I hope I have addressed it. Okay. Ranjit Mishra has asked, directors occupy building as a home. Can it be investment property? No, Ranjit, it cannot be investment property, because the term used in the standard is for owner occupied property includes employee occupied property. So assuming that your director is a whole-time director and assuming is an executive director, the housing that is given to him will not represent an investment property. It would represent a property, plant and equipment. Okay, so that answers Ranjit's question. Sir, is there any compulsory reassessing investment property at regular intervals? Because if the intention of company changes further to determine investment property, yes, Chala, I will just discuss. Chala Purushottam is one step ahead of our discussion. Okay, he's having a lot of questions, one step ahead of the discussion. And yes, I'm going to address your queries immediately after I complete these cases. Okay, that query I will be addressing immediately after completing these cases. Okay, property held for future use as owner occupied property. Intention is owner occupied. So today you are holding it for future use as owner occupied property. It cannot be investment property. It will come under PPE. Property held for future development and subsequent use as owner occupied property. Property is under development right now, but what is the intention? Intention is as use as an owner occupied property. Intention is to use it as an owner occupied property. Property occupied by employees, whether or not the employees pay rent at market rates. Ranjit, this case is discussing what you had asked. Assuming your director is an employee, whole-time employee, whole-time director, at that point of time, you can see this is the case. Property occupied by employees will not be investment property. It would be owner-occupied property. Okay. Next, owner-occupied property held for disposal. Held for disposal comes under Ind AS 105, which we will be discussing after this standard gets over. After this standard gets over. Property held, owned or held as a right of use asset leased to another entity under a finance lease. So A Limited owns or has a right of use asset and it gives it on lease. Now this lease is a long-term lease. This lease satisfies the definition of Ind AS 116. This lease satisfies the definition of Ind AS 116. It will be recorded as per Ind AS 116 because you are meeting the requirements of a lease and leases are specifically covered under Ind AS 116. For investment property, it is rentals or short-term leases. There is an exclusion clause which is mentioned, short-term leases under Ind AS 116. We are talking about those leases only. We are talking about those leases only. Okay. So now this completes my examples. So now let us look at this question from an auditor standpoint. I have marked some items in red and I have mentioned two auditing standards, SA 560 and SA 580. I'll just take your liberty because you know Challa has asked a question, do we need to reassess it regularly? Because these items can be interchanged from investment property to property, plant and equipment and otherwise, and the answer is yes. But as an auditor, what becomes your responsibility? Okay, so let us assume we are talking about the year 1/4/2020 to 31st March 2021. Now let us assume during this year the company has acquired a property. The company has acquired a property. Now when the company has acquired a property, normally the intention for such acquisition would be known. But in the examples that we have seen today, there could be a property that does not have a determined future use right now. Currently I am holding it, but I have not yet decided what I will use it for. Or I have a case where the intention is to hold it as a investment property. The intention is to use it as a property, plant and equipment item. The intention is to give it out for the purposes of earning rentals. The intention is to make a capital appreciation as my objective. The intention could be for future use as my property. So what is going to happen to the auditor who is auditing the financial statements as on 31st March? The auditor must be aware that today the company is having a property with undetermined future use. So therefore, SA 560, which deals with subsequent events, SA 560, which deals with subsequent events, that tells us events up to the auditor's report, he has to be, he has to be vigilant. He has to observe whether these properties which talked about future intended use, is that future intended use clear up to the date of auditor's report? Is that future use clear up to the date of auditor's report? Suppose he gets evidence that they mentioned that it is going to be used as investment property, but after 31st March, before audit report date, that property has been used as owner occupied property. That point of time, the auditor may have to say that, sorry, this cannot be classified as investment property. This will be owner occupied property. So there we talk about SA 560. But even as on the auditor's report, suppose the use is still not clear, it is still dependent on future factors. At that point of time, you have to obtain written representations from the management. At that point of time, you have to obtain written representations from the management. The company has to continuously make an assessment of its properties, whether it is investment property or whether it is property, plant and equipment, because there could be a case where there could be an overlap. Okay, so therefore the company needs to assess on a regular basis. Okay, so that completes our cases. Okay, is there any compulsory reassessment? Answer is standard does not prescribe, but you have to do a reassessment. And auditor's responsibilities, he has to apply SA 560 when required for the events up to the date of auditor's report. SA 580, he has to obtain written representations to confirm that the entity intends to use it either as an investment property or either as an owner occupied property, as the case may be. Okay, so this completes the cases of investment property, and we have also studied a small linkage to your practical standards. Okay, SA 560, SA 580. Okay, so this completes the cases which are there in your study module, the examples. Okay, now there was a question that we had, sir, if property has more than one use, how do I treat that? Okay, so the next topic that we discuss is property having more than one use. Let us assume that I have a building, the company owns a building, A Limited owns a 10-storied building. Okay, 10-storied building. Okay, sorry, not 10, let us assume 4-storied building. Okay, I cannot draw 10, so I drew 4. Okay, so 4-storied building it is owning, and then let us assume that the company can split these different stories into separate properties. The company can split these floors into separate properties, and it can use, say, the ground floor for its own purposes. It can give the first floor on rent. It can use the third floor also for rent, and the last floor it can use it for own use. So if you are able to split, at that point of time, this single property will now be divided into fourth floor and top floor and ground floor. These two floors will be categorized as property, plant and equipment, owner occupied property. They would be treated under Ind AS 16. Whereas these floors which I have given on rent, they would be treated as investment properties. They would be treated as investment properties. The important requirement is, if this investment property is capable of being split, Capable of being split. Capable of being split means what? I should be able to treat these properties independently. I should be able to enter into independent lease arrangements. I should be able to, independently sell it off. Okay, so when I have this degree of independence in respect of these properties, that point of time I will say that I can split it, and when I can split it, I do the split. Items which meet the definition of investment property, I record it as per Ind AS 40. Items which do not meet the definition of Ind AS 40, I treat it under Ind AS 16, for example. Okay. Now the question arises, sir, what if I cannot split? If I cannot split, then what would be the scenario? So suppose I have this property, but splitting is not possible. Splitting is not possible. These 4 floors are a single unit for the company. The company cannot, independently enter into a sale or lease agreement for 1 floor. Okay, the company cannot independently enter into a sale or lease agreement for 1 floor. So at that point of time, you have to see what is the owner occupied portion. What is the owner occupied portion? If the owner occupied portion is significant, significant, it would be covered under Ind AS 16. If the owner occupied portion is significant, it would be covered under Ind AS 16. If the owner occupied portion is insignificant, it would be under Ind AS 40. It would be under Ind AS 40. Now, what is significant, what is insignificant? This is clearly a matter of judgment. So therefore, the standard does not prescribe 25% is significant, 50% is significant. Nowhere does the standard give a prescriptive measure. To these Ind AS requirements that we are having, these Ind ASs are principle based and they are not prescriptive based. Okay, so when we have to follow the principles of Ind AS, we have to apply the principles in the true spirit of what they intend to be. So nowhere will you find a cutoff percentage that would be mentioned. In other standards also the case would be the same. You will not have any cutoff measures. You do not have any cutthroat percentages which are defined in the standard, wherein they say this is the percentage, treatment will be like this. If this is the percentage, there would be a different treatment. That is not going to be mentioned in any of the standards. It is a principle based approach that the Ind AS regime has adopted, that is coming from the IFRS regime. Okay, so significant Ind AS 16, insignificant Ind AS 40. And if you are able to split, please split your properties. The property which are owner occupied will be Ind AS 16. The properties which generate rental incomes, they would be under Ind AS 40. Okay, I'll just see your questions. No questions so far. Just take 10 seconds for any question that is there. No questions so far. Okay. Alright. Let's proceed next. This is a question that is taken from your study material. The next example, page number 7.3 to 7. That is an example in your study module. Sun Limited owns a building having 15 floors, of which it uses 5 floors for its office. So owner occupied. The remaining 10 floors are leased out to tenants under operating leases. According to law, the company could sell legal title to the 10 floors while retaining a legal title to the other 5 floors. So I have 15, out of which 5 is owner occupied, 10 is rented out. Now you tell me, what will this be? Am I able to split? And the answer to am I able to split lies in the question itself. The last line of the question tells us the company could sell legal title to these 10 floors while retaining these 5. That means the building can be split into different stories and I can sell the independent floors also and I can retain the other floors. So I do have the ability to split. So when I have the ability to split, I should do the split and I should ensure that these 5 floors should be treated as Ind AS 16. These 10 floors should be treated as investment property in terms of Ind AS 40. Sir, what would be the case if it was 1 versus 40? 1 floor I keep, 14 floors I rent it out. as long as the ability to split exists, as long as the ability to split exists, I have to account for it based on the fact that I can split. So therefore, one floor will be regarded as owner occupied, 14 floors will be regarded as investment property. You can apply the test of significance only if you cannot split. Only if you cannot split. If you can split, please do the split and do the accounting accordingly. Because if you apply the significance test here, you are not giving a faithful representation. You are not giving a faithful representation. Okay, next. Sir, what is sublet rental from my lessee as part of an agreement? Is this investment property? Yes, we have discussed this case, Purushottam. Okay, we have discussed this. I own it as a right of use asset for earning rentals. That is also covered under Ind AS 40. That is also covered under Ind AS 40. Okay. The second example on slide number 8. Moon Limited uses 35% of the office floor space of the building as its head office. So I have my building which represents 100%, 35% of it I use it as my head office, and remaining 65% I lease it out. Remaining 65% I lease it out, but it is unable to sell the tenant's space. It is unable to sell the tenant space. That means this 65% I cannot sell it independently. It is either the whole building goes or I keep the whole building to myself. I cannot do the split. So in this case, the second requirement applies. Is the split possible? The answer is the split is not possible. And because the split is not possible, you have to decide now whether a significant portion is an owner-occupied property or whether an insignificant portion is an owner-occupied property. 35% is clearly significant. Okay, please don't say 35% is less than 50. 35% is significant. Okay, it is more than 1/3. So it represents a significant amount which is an owner-occupied property. So what you need to do is the entire property will be recognized as an owner-occupied property. The entire property will be recognized as owner-occupied. If this was a small percentage, only then we had to treat it as an investment property as a whole. Why? Because the split is not possible. The split would not be possible. What is the percentage for significant, insignificant? There is no prescription that is laid out in the standard. So, you have to apply your judgment, whether it is significant, whether it is insignificant. And based on that judgment, you have to arrive at your accounting treatment. So as auditors, it becomes sometimes difficult to, appraise the judgment that is taken by the company. It becomes difficult to appraise the judgment that is taken because you have to question how this particular percentage you have taken it as significant, how have you taken it as insignificant. Anyways, that completes our example on slide 8. Let us come to slide 9. Okay. Let us come to slide 9. Now, an entity, this is also taken from your study module, page number 7.327. Okay. An entity owns a hotel which includes a health and fitness center housed in a separate building that is part of the premises of the entire hotel. The owner operates the hotel and other facilities. The owner operates the hotel and other facilities on the hotel with the exception of the health and fitness center. With the exception of the health and fitness center, which can be sold or leased out under a finance lease. Which can be sold or leased out under a finance lease. the health and fitness center will be leased to an independent operator. Will be leased to an independent operator. The entity has no further involvement in the health and fitness center. So the answer is, if the health and fitness center could not be sold or leased out separately on a finance lease, then because the owner occupied is not insignificant, the whole property would be treated as an owner occupied property. The whole property would be treated as an owner occupied property. Okay, so these two questions are done. Please check. Okay. The video is getting blurred in the middle, and okay, it is creating a problem. Okay. Then this must be because of the net. जय, मेरा वीडियो ठीक है? जय, वीडियो ठीक है मेरा? बहुत सारा टाइम ब्लरी होता जा रहा है. Is it getting blurred a lot? ओके, आप थोड़ा इनको रिज्यूमिंग. हाँ, ओके, जस्ट अ मिनट राहुल, विल बी. Okay. All right. I apologize for the small technical snag that was there. Rahul, I got your messages. No problem. You people need to see what I write. That was the reason I had to take this short break. Okay. I hope things get clear. In the second session, we will again try to improvise. Okay. The technology snags are sometimes beyond my control as well. Okay. So anyways, so now we were discussing the case studies. We discussed slide number 9, and now let us come to slide number 10 that talks about ancillary services. Now, what is an ancillary service? What is an ancillary service? And what is its repercussion when it comes to investment property? Okay, so what is it when we talk about ancillary service, and what is its repercussion when it comes to investment property? So let us assume that the entity has given a building on rent. The entity has given a building on rent, and as a part of the rental arrangement, the entity agrees to provide certain services to the customer. The entity agrees to provide certain services to the party. So now the question that arises is, these services are a part of my renting arrangement. These services are a part of my renting arrangement. Okay, so when they are a part of my renting arrangement, the significance of those services has to be taken into consideration. The significance of those services has to be taken into consideration. Let us take a very simple example of a hotel. Okay, so most of us know hotels, rooms are given on daily tariff basis, right? Rooms are given on daily tariff basis. So when rooms are given on daily tariff basis, the purpose behind which my hotel is constructed is so that I can generate income by renting out the hotel to my customers. By renting out the hotel to my customers. Essentially, hotel is renting out of the space itself, but along with the letting out of the space, the hotel provides various other services. Like, sir, what are the other services the hotel will provide? The services that would be provided include food, they could include a spa center, they could include casinos, they could include various other services which are provided to the customers. So at this point of time, the renting arrangement between the hotel and its customers is not just a simple renting arrangement. Rather, it is renting coupled with services that are being provided by the entity. Coupled with services that are being provided by the entity. So when this is the scenario, how does Ind AS 40 address it? Because if Ind AS 40 would not have addressed it, all the hotels would have a difficult position in classifying their hotel properties as investment property or as property, plant and equipment. To address these reasons, the standard has introduced the concept of ancillary services. The standard has introduced the concept of ancillary services. Now, if my ancillary services are significant to the arrangement as a whole, that means renting is there, but along with the rent, the services that have to be provided by the entity to that person who is taking the property on rent, if those services are significant, that point of time, the property would be regarded as an owner-occupied property. At that point of time, the property would be regarded as an owner-occupied property. So what is my thumb rule? Ancillary services are significant, then it would be owner-occupied property. So when I talk about hotel, Clearly, you do not have visitors who just come to the hotel to take the property on rent. Rather, they would come to, enjoy the buffet breakfast that is served. They would come to enjoy a spa session. They would come to play in the casino. They would come to, enter the health and fitness center of the hotel. They partake all the various services which are provided. So when they partake all the various services, the hotel arrangement is not just renting, but it is renting coupled with provision of ancillary services which are significant. So in this case, the hotel would be regarded as an owner-occupied property and it would not be regarded as an investment property. I hope that is clear. Now let us look at the converse case. You have some services which are being provided. You have some services which are being provided, but those services are insignificant. Those services are insignificant. Let us assume I have let out a property, I have let out a building, and the entity promises to carry out the security services of the building, or the entity promises to carry out the minor repairs and maintenance up to a threshold amount of the building. So when this is the scenario, you have to see what is the major element of service. In this case, major element is renting out, and the minor element, the insignificant element, is provision of, let us say, security services, provision of, let us assume, any other service which is not significant. So when this is the case, the property will be regarded as an investment property. When this is the case, the property will be regarded as an investment property. So therefore, renting plus ancillary services, my thumb rule is services are significant, owner occupied property. Services are insignificant, investment property. So we have seen two cases of investment properties today. Investment properties that can be split, investment properties that cannot be split. And in the case of ancillary services provided as a part of the renting arrangement, services are significant, services are insignificant. In both these cases, the insignificance is an important factor in classifying the property as an investment property. If my owner occupation was insignificant in the earlier case, it would represent investment property where you cannot split. If my ancillary services are insignificant, they would represent an investment property. So again, let us come to the questions that are there in the presentation. You can open slide number 11. Okay, you can open slide number 11. These are some questions which I have prepared. Now just go through these questions. We'll be discussing them right now. I want you people to present an answer to me in this regard. This is much of what we have discussed right now. Vacation Stays Limited, a company covered under the Ind AS framework, is engaged in the hospitality industry. It has various hotels situated across India. Okay. It provides guests with accommodation, food, recreational and sports facilities such as snooker, tennis as well as golf. It also provides guests with spa as well as sightseeing services. The services could be either bundled as a package and offered to its guests, or it could be priced separately depending on the customer's tastes. Would the properties qualify as an investment property or as an owner-occupied property? Yes. So could you please answer? In the case of question 1, would you please answer what would it represent? Clearly, the services relating to food, recreational and sports facilities, spa and sightseeing activities, they are significant. The fact that a customer may not avail does not preclude the fact that the company is providing ancillary services of a nature which are significant, So therefore, this hotel property would be regarded as a property, plant and equipment. As a property, plant and equipment. Okay. So now this is done. Let us come to question number 2. Any doubts? Please feel free to ask. I hope you have gone through question 1. I will give you 2 minutes time. Okay. I will give you 10 seconds. Please tell me whether you have any doubts in question 1. Whether you have any doubts in question 1. No doubts? So then we shall proceed further. Let us proceed to question 2. Modifying the above example, assume that in all the properties, the spa is based in a separate building on the resort premises. There is a spa in all its premises. It is based in a separate building. Now the operations of the spa are managed by an independent operator to whom the spa building is leased. Now the spa building is leased and you have given the spa building to the independent operator to carry out the services. The spa facility can be availed by the tourists as well as the local guests. So those who are there occupying the hotel, they can definitely avail the spa services. But even those who are already outsiders, localites, they can also come to avail the spa services. The spa facility can be availed by tourists as well as local guests. The spa operator has agreed to operate the spa only if the hotel is under operation. Only if the hotel is under operation. How would the spa buildings be treated? How would the spa buildings be treated? Okay. Alright. So now more answers. Rahul has given an answer. Spa is a separate investment property. Other answers? I need 1 or 2 of you to please answer this. Let us wait for 10-15 seconds. Spa is a separate investment property. Okay. Okay. So now in this case, there could be 2 points of argument. Okay. In the first case, if we just read it as a separate building on the resort premises, independently it is leased. If you just read that part of the problem, it would be regarded as an investment property. But you look at the subsequent parts. The spa facility can be availed by the tourists as well as the local guests and agreed to operate only if the hotel is under operation. So in this case, the cash flows of the spa would be largely dependent on both the factors, the tourists as well as the local guests. The cash flows would largely be dependent on both the factors. That means the cash inflows in this case from the spa would not necessarily be independent. The cash flows in this case would not necessarily be independent. This is a kind of an arrangement where the spa activities are given to be managed by a particular entity which is specialized in that services. Now in this case, that entity has put a condition. The spa will run only if the hotel is running. So this is your differentiating factor. The spa can be availed by the tourist as well as the local guests. The spa operator has agreed to operate the spa only if the hotel is under operation. So the cash flows of the spa will depend on the cash flows from the hotel. That means when the hotel is under operation. So therefore, you cannot treat it as an investment property. You will continue to treat it as an owner-occupied property in this case. The first part of the problem is meant to provide you an information that makes you to understand it as an investment property. But the second part tells us that one is cash flows are not largely independent. They depend only when the hotel is functioning, and it is a separate building, yes, but it is on the same resort premises. It is on the same resort premises. So these two things you can take it out as a case where the property will be regarded as an owner occupied property, where the property will be regarded as an owner occupied property. Okay, so I hope that this part is clear to everyone. Question number 2 is clear, question number 1 is clear. Let us come to question 3. Okay, let us come to question 3. In continuation of question 1, not illustration 1, I am continuing the same problem, this about this hotel. In continuation of question 1, given the large impact of the COVID-19 pandemic on the hospitality industry, the company decided to shut all the operations such as spa, recreational facilities, etc., and terminated the respective employees' services. Okay, it now listed its properties on Airbnb, wherein guests could book and enjoy their stay. No further facilities were provided by Vacation Stays Limited. Would there be any change in the classification of the property? Okay, so just a couple of responses I need for this illustration now, please. Yes, illustration question 3. This hotel, which was running earlier, the COVID-19 pandemic came, they decided to terminate all the employees who are providing ancillary services, and the company has said from now we will no longer provide the ancillary services. So all spa, recreational activities, sports facilities, everything is shut down. Employees are terminated. Now the hotel rooms are listed on Airbnb. The hotel rooms are listed on Airbnb. So any guest who wants to come, they will do the booking on Airbnb. They will come and stay in this hotel. It is only a stay property now. There are no services that will be provided by the hotel. There may be some insignificant services like an airport pickup and drop, or a railway station pickup and drop. But largely these services cannot be categorized as significant. Largely these services cannot be categorized as significant. It no longer remains as an owner occupied property, because now the activity that happens is just a renting of space activity that is going to go on. It is only a renting of space activity that is going to be carried out. So therefore, in this scenario, the hotel, which was an owner occupied property earlier, will no longer be regarded as an owner occupied property. Rather, there will be a change in its classification from owner occupied property to investment property. From owner occupied property to investment property. Yeah, Rahul, your answer is right. It is an investment property now, as the cash flows are largely from renting the rooms and they are largely independent. Okay, so you see, you have circumstances like in this case, I've just drawn an example that I had created, but you have cases where the circumstantial change that will happen could lead to a change in the business models of the entity. And because of the change in the business models of the entity, there could be a change in the classification of your assets and liabilities. There could be change in the classification of your assets and liabilities. So this is an example where the hotel industry, the hotel itself has shut down all other operations, only giving the properties on lease, on rent to its guests. So therefore, it will be classified as an investment property. It will be classified now as an investment property. Okay. Now, come to the next slide, slide number 13. This is from your study module. The owner of an office building provides security and maintenance services to the lessees who occupy the building. Provides security and maintenance services to the lessees who occupy the building. So assuming that security and maintenance is insignificant, assuming that the maintenance and security is insignificant, it actually is insignificant. then in that case, this property would be regarded as an investment property. If the entity owns and manages a hotel, services provided to guests are significant to the arrangement as a whole, So that point of time, my hotel property will be regarded as an owner occupied property, Is it okay? Are these examples clear to you? Yes? Any doubts so far? Just confirm. I give you 10-15 seconds to confirm. Shivagami, Rahul, Purushottam, you have asked a question on auditor's report. I will be addressing it. Okay. Now, sir, Rahul has asked a question. Sir, in question 3, the entity is in the business of hospitality and renting of rooms is an integral part of its operations. Shouldn't it be considered as owner occupied irrespective of the fact that whether it provides ancillary services or not, as it would be considered as property, plant and equipment for the entity? Okay, in this case, Rahul, there has been a change in the business model of the entity. It has stopped providing recreational services. It has listed the properties on a site that is known for renting it out, and we consequently assume that these changes would have been reflected in the incorporation documents as well. So in all these circumstances, considering all these factors put together, we can assume that there is a change in the business model. We can assume that the classification will be shifted from a property, plant and equipment to an investment property. Because in this case, the cash flows are coming from the business operation, which is renting the rooms. The cash flows are coming from a business operation, which is renting the rooms. That is the only activity of the entity now. It is not as in the case of an entity which provides some other goods and services as well as a renting property. In this case now, my guests who come and stay with me, they meet the definition of customer as laid down in Ind AS 115. They meet the definition of customers as laid down in Ind AS 115. The definition being, they are the recipient of goods and services which are provided by the entity in the ordinary course of business. They are the recipient of goods and services which are provided by the entity in the ordinary course of business. Now, in the ordinary course of business, the renting activity is taking place. In the ordinary course of business, the renting activity is taking place. So therefore, it will not be regarded as an investment property, but it will be regarded henceforth as an owner-occupied property. Why? Because all the other services are shut down. This is a case of a company which is only into hotel business. This is a case of a company which is only into hotel business. Okay, so keep that in mind and then you will be able to understand the reasoning behind this question. You will be able to understand the reasoning. It is not an entity that provides others. Okay, it is not an entity that provides other services. Okay, so now let us come to slide number 14. Let us come to slide number 14. Difficulty in classification. Difficulty arises in classification. Very interesting topic. Okay, you have seen now today, just when I was discussing these examples, there were varied answers that were coming because somebody has judged the property to be a PPE based on some criteria, whereas another student has judged the property as an investment property based on some criteria. So the question arises, there could be a difficulty in classification and ultimately it is a game of judgments. Okay, ultimately it is a game of judgments. In this case, the standard again does not prescribe what is significant service. Ancillary services we discussed, if the services are significant, then if that be the case, What would be the proportion of significance? Does it say if ancillary services contribute to 30% of total revenue, for example, would it be considered significant? If the revenues contribute 50%, would it be significant? If they contribute only 10%, would it be insignificant? And the answer is the standard does not prescribe such limits. The standard does not prescribe whether a service is significant or whether a service would be insignificant. It is a pure judgment that has to be taken by the entity. It is a pure judgment that has to be taken by the entity. And accordingly, this is going to be let us take an example to understand now. Let us assume the entity is owning a hotel, but there are two models. Okay, the first model, the entity is a passive investor. It has just provided the capital, invested in the hotel. It is entitled to certain returns, fixed returns, for example, no variation in cash flows, and it has given the operations of entity to some third party. It has given the operation of the hotel to some third party. And the answer to that is, this represents an arrangement where the investor is a passive investor. It is as if he has put his money on a fixed deposit. As if he has put his money on a fixed deposit. He is not going to be recognized as a person who is exposed to the variation in cash flows. He is not going to be recognized as a person who is going to be exposed to the variation in the cash flows. In other words, this investment company is having a 0% participation in the hotel activities. This investment company is having 0% investment, is having 0% participation in the hotel activities. As compared to this, take the other extreme now. Only day-to-day functions are outsourced, and this entity, this company that has constructed the hotel, they are entirely exposed to variation in cash flows. For example, I have a company, it had made an investment in a hotel. That hotel operations are given to a third party, and now it is COVID, the hotel is closed. So therefore, because the hotel is closed, this investor also does not get any return. This investor also does not get any return. So this would be the other end of the extreme, wherein the investor is fully exposed to the variation in cash flows. Wherein the investor is fully exposed to the variation in cash flows. So now this is my broad spectrum, from no participation to participation. Now the question arises, what would be my cutoff percentage? What would be my cutoff percentage at which I can say this will be an owner-occupied property, this will be an investment property? And the answer to that is, sir, it is not prescribed in the standard. It is not prescribed in the standard, and therefore it is a very highly judgmental call that has to be taken. A very high judgmental call has to be taken by the entity, and therefore in terms of SA 315, identifying and assessing risks of material misstatement through understanding the entity and its environment. You remember your audited standards in terms of SA 315, this judgment becomes an item, a risk of material misstatement. So therefore, the auditor's job gets more and more difficult, because now he has to wade through judgments and arrive at a conclusion. He has to sail through the judgments. He has to question the judgments which are made and arrive at his understanding of whether it would be classified as
an investment property, or whether it would be classified as an owner occupied property, whether it would be classified as an owner occupied property. So this is what is the problem. You see, when you come to this level of your final CA financial reporting, the focus will naturally come, and once you clear your exam, the focus will naturally come towards analyzing the judgments, analyzing the manner in which financial statements are being prepared, analyzing why a particular treatment has been opted by a company, and finally questioning that treatment and questioning why the alternative treatment has not been applied. Okay, so when you do this questioning, it is going to lead you to a scenario where the judgments will be questioned, the estimates will be questioned, the basis of preparation, the basis of arriving at a classification will be questioned. It is not really material for us at that point of time whether our balance sheets get tallied or not, because it is an IT environment outside. Your balance sheets automatically get tallied. So therefore, the focus is shifted radically from an arithmetical accuracy kind of an audit-based approach to an approach where judgments, estimates, and risks will play a significant role in forming your audit opinion. Will play a significant role in forming your audit opinion. The IFRS principles, the Ind AS principles that we follow in India, they are all principle based. They are all principle based. Whereas if we talk about the United States, those are all rules based principles. So those are all rules based criteria. A rule is given. If you follow that rule, you are safe. If you do not follow that rule, you will be reported. Okay, you will be reported upon by the auditor. Each has its advantages, disadvantages. Advantage of rule based: auditor's job is very simple. Rule is followed, acceptable. Rule is not followed, do not accept. But it becomes difficult. There are so many business models, and in those business models, there could be cases where the rules itself would not be framed by the regulators. So when the rules are not framed, how will the auditor do the audit? That comes the question that is answerable. And in our principles based approach, the principles decide everything. So the auditor's understanding of the judgments becomes more and more difficult, more and more complex. Okay, all right. Shivgami has asked a question: if I'm going to close my business and my goods, buildings will be treated like investment property if I hold this for my purpose and I sold it after 12 or 13 months. Okay, Shivagami, if you are going to close your business and your intention is to recover your carrying amount by sale and not by use, at that point of time, it will be held for sale property. I think the students who are attending this, they are, quite far-sighted. Today, more than 50% of the queries which I am receiving, they are all pertinent to the future discussions. Okay, so this question asked by Shivagami will be discussed when I do Ind AS 105. Will be discussed when I do Ind AS 105, the very next standard that we will now be discussing. The very next standard that we will be discussing. Okay, so Shivagami, please park your questions. I am not parking because I do not know, but because these things are going to be discussed in the future. Okay, so now come to slide number 15, difficulty in classification. It is a game of judgments. Once again, I have to repeat that. And there are cases when the entity itself is in a dilemma. It is not clear as to whether mine is an investment property, whether my property falls under the definition of PPE. So therefore, what the entity must do is, it must establish the criteria. Like the entity should have clear-cut policy guidelines laid down that if these conditions are met, then it would be regarded as an investment property. If these conditions are not met, it would be regarded as an investment as a holding of property, plant and equipment. These criteria would help the company to consistently recognize your investment property. To consistently recognize your investment property correctly, to consistently recognize it correctly. Okay, if these criteria are not detailed, then there could be a possibility that 1 year you recognize a property under investment property, similar cases you purchase a property in another year, you classify it as a property, plant and equipment, because it is a judgment based case. It is a judgment based case at the end of the day. Suppose the accountant who classified it as an investment property resigns from the organization, a new accountant comes, he is aware of the ASs and then he feels that it should be a property, plant and equipment, the new property which is acquired, he treats it under PPE. So similar criteria, different treatments is inconsistency, and the standard tells you please avoid this inconsistency. Please avoid this inconsistency. Lay down the criteria to ensure consistency in classification. To ensure consistency in classification. And this criteria should be disclosed in your financial statements. This criteria should be disclosed, particularly when the classification is difficult. Particularly when your classification is difficult, you have to disclose this criteria and then you have to disclose in the financials that based on this criteria, my property has been recognized as an investment property. My property has been classified as an investment property. So judgment as to the acquisition of investment property, there are 3 questions which we have to answer. Is it an acquisition of an asset or a group of assets? So that is what we have to understand and see what is exactly the nature of my transaction, or if your acquisition is pursuant to a business combination, or if your acquisition is pursuant to a business combination. If the criteria, if the acquisition is pursuant to a business combination, then the principles laid down in Ind AS 103 will apply. The principles laid down in Ind AS 103 will apply. It won't be these principles. These criteria are only for helping me understand whether a property is an investment property or otherwise. Whereas if it is a subject matter of a business combination, that point of time you have to use the principles laid down in Ind AS 103. You cannot use this criteria. This criteria is only for demarcating whether it is an investment property or whether it is not an investment property. The standard gives the principles, but you have to frame the rules in agreement with those principles. You have to frame the rules because you cannot lose consistency. You cannot lose consistency as a reporting entity. You cannot lose consistency as a reporting entity. Okay. Now we come to Purushottam's question that he had asked. If it is a strategic business unit, let us assume that it is held as a subsidiary. I have given a strategic business unit operations. I have formulated a wholly owned subsidiary and I have rented out my property to that subsidiary. I have rented out my property to that subsidiary. So you have slide number 16 which discusses that model. Okay, so in this case the holding company holds the investment property under Ind AS 40. Why? Because the purpose is to rent it out. The purpose is to rent it out. Now when this is the case, in the separate financials of H Limited, it will be regarded as an investment property. And S Limited, the rental expenses, lease expenses would be recognized on a systematic basis in the separate financial statements. Systematic basis means generally you can take it as a straight line method. So there is a short-term lease of immovable property from the holding to the subsidiary. It will be the investment property recognized for H Limited. But now you talk about the consolidated financial statements, the entire group as a whole. Now you tell me whether this property would be recognized as an investment property, and the answer is no. And the answer is no. In the consolidated financial statements, this property would be recognized as an owner-occupied property. So there is a single transaction, but two different treatments are being given. In the separate financial statements, investment property. In the consolidated financial statements, we present the group results as a single entity. We present the group results as a single entity. In this case, my group is holding that asset. I have not entered into a short-term lease arrangement with a party outside the group. No, I have entered into a lease arrangement with party within my own group. So therefore, in the consolidated financial statements, these transactions will not be reflected, these properties will not be reflected as an investment property. Rather, it will be reflected as an owner-occupied property under Ind AS 16. What is the rental expense for S Limited would be cancelled out against the rental income of H Limited when you are consolidating your statement of profit and loss. Why? Because they would represent transactions between members of the group. So you cancel them out, you cancel the rental income against the rental expense, and the property which was classified as an investment property in the separate financial statements, in the CFS it would be classified as an owner-occupied property. So Purushottam, I think I have answered that part when you talked about an SBU. Okay, next let us come to slide number 17, wherein you are given certain a tabular summarization is given. This is drawn right from your module itself. Okay, so owned by a company, leased out under an operating lease, that comes under Ind AS 40. Held as a right to use asset, that means I have obtained it on lease and it meets the requirements of a lease under Ind AS 116 and leased out under an operating lease. Please read operating lease as a short-term lease. In that case, I got the asset, I show it as a right of use asset. That asset, the building I am letting it out under a short-term lease. So therefore, I have got the right to use asset to earn rental incomes. That will be regarded as an investment property. Held as a right to use asset and leased out under finance lease. Now here you got an asset which is a right to use asset. It meets the lease criteria under Ind AS 116. You have leased that out. That would be a lease which meets the criteria of Ind AS 116. The accounting of this arrangement would be not as per Ind AS 40, but it would be as per Ind AS 116. So I got a right to use asset given on short-term lease, investment property. I got a right to use asset given on a lease in terms of Ind AS 116. It would be accounted as per Ind AS 116. Property acquired with a view for development and resale. This is a scenario where it is an owner-occupied property. This is a case where it is an owner-occupied property. It is all very clear. We have discussed these examples at length today. Okay. Partly owner-occupied and partly leased out. What is your treatment going to be? It depends on the significance. It depends on the significance of how much I have occupied as an owner. If a significant portion is occupied, it will be a property, plant and equipment. If an insignificant portion is occupied, it will be regarded as an it will be regarded as an investment property. Assuming that you cannot split. Assuming that you cannot split. If you can split, please split and account for the items accordingly. So therefore, does it meet definition of investment property? The column says it depends. Currently undetermined use, investment property. I had some cash, I invested it in a land. I do not know what I will do with that. So your intention is to probably park your cash somewhere. So therefore you parked it in the land, it will meet the definition of an investment property. Property occupied by employees, it is going to be owner occupied. We have discussed this case. Investment property held for sale, subject matter of next standard. Existing investment property redeveloped for continued use as investment property. Continued use as investment property. Those words are important. It will meet the definition of an investment property. So you need to understand what is the criteria based on which I can recognize investment property. That is an important part. You need to identify what are going to be my judgments. You need to list down what is my criteria, and basis that criteria you need to make a classification accordingly. You need to make a classification accordingly. Is it okay? Yes. Any doubts so far? Because now we move on to the recognition principles. Okay. I'll just wait for 15 seconds. Please tell me if you have any doubts so far. Shivagami was the last one who asked. There has been no question thereafter. Rahul is there. Okay. All right. So that completes a lot of theory about investment property. That completes a lot of theory about investment property. We can take a quick 5-minute break. We will resume after 5 minutes. Okay. We will resume after 5 minutes. Okay. Just a 5-minute break. We will meet by 9:27. Okay. About 9:30. All right. So that's it. 5-minute break, everyone. Okay. Jay. Jay, 5-minute break. Break is put up, right? Okay, all right. So a lot of theory has been discussed so far about what is investment property, how to classify investment property, is it an investment property or not, what are the judgments involved, can I split my investment property, what would be the case when ancillary services are provided. Lot of theory has been discussed. We shall now come to the recognition principles, wherein we discuss about at what value my investment property will be recognized and what are the principles governing that. Remember, the objective of this standard is to provide measurement principles also, the entire accounting treatment of investment properties. So therefore, we talk about the general principle of recognition that is outlined in this standard. It says that you recognize an investment property when two conditions are met. The future economic benefits, it is probable that it will flow, and the cost is reliably measurable. But wait a minute, we have seen this somewhere. Yes, we have seen it in Ind AS 16, and moreover, it is in line with the framework. The framework tells that you have to recognize an asset when it is probable that future economic benefits will flow to the entity and when the cost of that asset is reliably measurable. So, when will my future economic benefits flow? When you will be entitled to the risks as well as the rewards associated with that asset, when you get a control over that asset, that would be the point for you to understand that yes, at this point of time, I can possibly recognize my investment property. But of course, subject to the fact that you can measure the costs reliably. As far as the investment property is held by a lessee, so therefore, A Limited gives an investment property on lease to B Limited. This lease satisfies the conditions of Ind AS 116. So B Limited recognizes it as a right of use asset, and later on B Limited leases it, gives it on a short-term lease to C Limited. At this point of time, you will do the measurement of investment property for B Limited in what manner? You will recognize it based on the principles laid down in Ind AS 116. Ind AS 116 do the present value of the lease payments. Those factors will lead to determining the value of the right of use asset. So here what you are measuring is the right of use asset. Not the building. Why? Because the building, the legal ownership is with A. You have taken it on lease, so you are going to measure that right of use asset. The principles of Ind AS 116 will be applied. So in general, future economic benefits, cost reliably measurable, same as Ind AS 16. Now when we proceed further, you will see that this standard has quite an amount of commonness between Ind AS 16. Okay, it is as if you are studying Ind AS 16 itself, but on a smaller scale. Okay. So now, subsequent costs. This is something that you have been doing right from your preliminary days. Okay. Day-to-day servicing costs. Okay. Some repairs, maintenance, whitewashing, painting of investment properties, any item of day-to-day nature, when you carry it out, those items will be recognized in the statement of profit and loss. In other words, they would be expensed. So revenue expenditure, you treat it as an expense, debited to your statement of profit and loss. Whereas in the case of replacement costs, when you replace a particular component of an investment property, at that point of time, how do I recognize? What does the standard tell me? Let us assume your investment property has multiple components, okay. So at that point of time, let us assume an investment property has components A, B and C. Now let us assume you want to replace component B, which could be a staircase, for example, in an investment property. You notice that the staircase has been damaged and you want to replace the staircase. So at that point of time, how do you recognize this replacement cost? The new staircase that you will add, this B represents a staircase. This staircase that you will introduce, this would be recognized provided it meets the recognition criteria. And what is my recognition criteria? Probable that future economic benefits will flow, number one. And second is costs can be measured reliably. When both these things are met, the new staircase will form a part of investment property, which is probably in a bad state. This old staircase will be derecognized. This old staircase will be derecognized. So therefore, this will be capitalized. This will be derecognized. Is it okay? All right, Dinesh. Okay, this is not able to see the video. Paper 3 advanced. Okay, that is not concerning me. Okay, so Ind AS 16. All right. Okay, next. Requirements same as per Ind AS 16. Okay, no change. Now, let us come to slide number 20. This is again picked up from your ICI illustrations. X Limited owns a building which is used to earn rentals. That means this is for rent. It meets the definition of an investment property. So it would be an investment property. The building has a carrying amount of 50 lakhs. Okay. X Limited recently replaced interior walls of the building and the cost of new interior walls is rupees 5 lakhs. The walls have a carrying amount of 1 lakh. Carrying amount is 1 lakh. X Limited should account for the above cost. Very simple. 50 lakhs is the carrying amount of the building and you have replaced the walls amount of 1 lakh. So subtract 1 and replaced it with walls worth 5 lakhs. So therefore, what is going to be your new amount? The new carrying amount is rupees 54 lakhs. The new carrying amount will be 54 lakhs. Okay. So this will be done provided these walls of 5 lakhs meet the recognition criteria. Provided these walls of 5 lakhs meet the recognition criteria. Okay. So once that is done, 54 lakhs would represent my amount of that investment property. Okay. So complete slide number 20 and now in slide number 21 you are having very familiar principles. Measure at recognition. The moment I acquire an property, what should be the measurement initially? What should be the measurement initially? And if it is a regular acquisition means what? Regular acquisition means on normal terms and conditions if you acquire. If there is, no deferred payments, if it is a regular payment that is being made, all cases are normal. At that point of time, how would you measure? Very simple. It would be cost. It would be at cost. It would be the purchase price plus the directly attributable costs. So whatever costs incurred to bring that investment property to its current location and condition, those costs would also be capitalized in the value of the investment property. Again, this is exactly the principles that we bring forward from 16. The standard as such is very simple. It's not a complex standard at all. Okay. The costs which you have to ignore are startup costs, operating losses that you incur until your investment property meets a particular level of operations and any abnormal wastes of materials, labor, etc. that you have incurred while you are acquiring this investment property, while you are constructing this investment property. So those three items you cannot capitalize, and these costs, purchase price plus directly costs, they will be capitalized in the value of the building. There may be a case where the consideration could be deferred. There may be a case where the consideration could be deferred. And deferred means what? I buy a building now, but I will make the payment after 3 years beyond normal credit terms. Okay, normally in immovable property, it is all going in terms of advance payments, right? You make the advance and finally the immovable property will be transferred to you. But in this case, this is a special transaction. I get the immovable property now. They have said payment to be made after 3 years. This is a special transaction. Here time plays a significant role. Time plays a significant role in your cost. So what does the standard tell you? In today's terms, what is the cash price equivalent? Cash price equivalent means if you pay today, how much will you pay? That would represent the cost, and the balance portion which you are paying extra, that would be my finance cost. Okay, so when payment is deferred beyond normal credit terms, that point of time the standard tells us that there is a financing element transaction, and because there is a financing element, at that point of time you have to book the investment property at the cash price equivalent. That means today's terms, what will be the value, and the balance excess amount that is there, it would be recognized as a finance cost. It would be recognized as a finance cost. Is it okay? So regular acquisition is done, deferred consideration is done. Both are terms that you are already aware of. Okay, let us now come to slide number 22. Two illustrations are there. Once again, it is up from your study material. Okay, X Limited purchased a building for 30 lakhs on 1st May 20X1. The purchase price was funded by a loan. Property transfer taxes and direct legal cost of 1 lakh and 20,000 respectively were incurred in acquiring the building. Okay, so these elements, 1 lakh as well as 20,000, they are directly attributable costs. So they would be capitalized in the value of the building. In 20X1X2, X Limited redeveloped the building into retail shops for rent under operating leases to independent parties. So once it got the building, it is going for a redevelopment. Expenditures on redevelopment were 2 lakhs for planning permission, 7 lakhs for construction costs, which includes 40,000 refundable by way of purchase taxes. The redevelopment was completed and the retail shops were ready for rental use on 2nd September 20X1. What is the cost of the building at initial recognition? Okay, so now first thing, I'll just do it in brief. Purchase cost is how much? 30 lakhs. Okay, add directly attributable expenses. So are having those two expenses, which is taxes and legal expenses. This is 1 lakh and 20,000. So 1 lakh and 20,000. So this total comes to 1 lakh 20. Okay. Now this is directly attributable expenses for acquiring this property. But once you acquired this property, you now want to give it on rent. So you are going for a redevelopment. Now those redevelopment development expenses, planning, permission and construction costs, they are also attributable expenditures to the investment. Without paying that, you cannot carry out your investment property objectives. You cannot give the shops on rent unless you incur that. So those also will be incurred. The 40,000 refundable purchase taxes. The 40,000 refundable purchase taxes, those will also be deducted. Why? Because they are refundable. You will get a benefit of that. So therefore, add redevelopment expenses, permissions. Permissions is, and the next one is construction cost. Construction costs would be 2 lakhs minus 7 lakhs minus 40,000. Why 40,000 is deducted? Because these are refundable purchase taxes. You can get a credit against it. Okay. So this would be 7 minus 40. This would be 6 lakh 60. So total 8 lakh 60,000. My investment property would have a recognition value 30 plus 8, 39 lakhs 80,000. This would have a value of 39 lakhs 80,000. Is it okay? Yeah. So this was question number illustration 2 on page 7.332. It's already there in your study module. Okay. Let us now proceed to illustration 3. Let us now proceed to illustration 3. Any doubts so far, anyone? I just give a 10-second gap, then we shall proceed. Alright. Next. Now let us proceed to illustration 3. Okay. Now, illustration 3. X Limited purchased a land worth rupees 1 crore. Okay. It has the option to either pay at the time of purchase or pay for it over 2 years for a total cost of rupees 1 crore 20 lakhs. What should be the cost of the building under both the payment methods? What should be the cost of the building under both the payment methods? Let us do this. I am having a deferred payment arrangement. Okay. In the second case. First case, today itself, if I make the payment, I have to pay 1 crore. If I have to make the payment over 2 years period, I have to make the payment of 1 crore 20 lakhs. So at that point of time, let us understand this increase of 20 lakhs is only because of passage of time. So this 20 lakhs would represent finance cost. This 20 lakhs would represent finance cost. It would be accounted for as such, and therefore this 20 lakhs cannot form property under both the circumstances. My investment property would be recognized at 1 crore rupees. Okay. I will just proceed one step further. This is not given in your study module. I am just proceeding one step further. Let us assume that the payment for this investment property is going to be made after 2 years. The payment is going to be made after 2 years. A single bullet payment will be made 1 crore 20 lakh rupees. So at this of time, can I say future value is 1 crore 20 lakhs? Yes or no? Can I say the future value is 1 crore 20 lakhs? And the answer is value is 1 crore 20. If I pay it in today's terms, that means right now, the present value would be 1 crore. The present value would be 1 crore. What is the time limit that I have? I have to pay after 2 years. I have to pay after 2 years. So T is equal to 2. T is equal to 2. And rate of, I do not know, but can I calculate? The answer is yes, you can obviously calculate. Present values are raised to T. Future value 1 crore 20 lakhs. Present value 1 crore 1 plus R whole squared. 1. Okay. So now I have only one variable R. Can you get me what is the rate of interest? I give you about 20 seconds. Yes. Please find out how to present answer. Yeah, Varsha, we'll be doing it. We're doing it right now. I have just extended the question a little bit because the question that in the module, they had explained only the first part. I'm just going a little ahead. Okay. So now, in this case, alright, tell me, what will be the rate? I need some answers now. 1 crore 20, present value 1 crore, 1 plus R the whole squared. So can you please get me what is going to be your value of R? What is going to be the value of R? Yes? Any answers? Any answers? Alright. Varsha, step-by-step presentation will fetch you the marks. Okay? Please mention a clear step-by-step concise presentation. Okay. So any answers for the value of R? Anyone? I hope the screen is visible, right? I have tried to minimize my writing, but I have kept it like this. What is the value of R? Anyone? Another 10-15 seconds before I can proceed. 1 plus R squared is equal to 1.2. So plus R is equal to root of 1.2. So when you solve like this, you will get R as 9.5445%. Okay, so this, yes, correct. Sneha got the answer. Varsha also got the answer, 9.5445. Okay, so this is right. I will be taking the full decimals only for this exam, only for this example, because I want to tell you that the value actually comes to 1 crore 20 lakhs. But what you have to do in your exam, rounding off is permissible. Up to 2 decimals is also fine. Okay. So now R is 9.4445. So in this case, now year 1. What is the journal entry that you will pass? First one, investment property debit. This will be 1 crore. Yes. You have recognition criteria. Only the payment is deferred. So recognition criteria is met. Cost measurable reliably. Future economic benefits probable that it you. So therefore, you will have to recognize it at 1 crore to creditors investment property. To creditors for investment property 1 crore. To creditors for investment property. This is the first entry. Then at the end of year 1, creditors for, sorry, not creditors, 1 minute. You finance cost debit to creditors for investment property. To creditors for investment property will be 1 crore multiplied by 9.5445%. 9.545%. So that gives, sir, how you made 1.2 to 12? It's not 12, it is point only. Okay, it is point only. Yeah, it is 1.2 only. I have not made it 12. The dot was not filled. Okay. So 1 crore into 9.5445. The first just finance cost will be 9 lakh 54,451, 9,54,451. Year 1, I will recognize a finance cost of 9,54,451. Now my total creditors balance will be 1,09,04,451. So now let us come to year 2 on top so that you will be able to see it clearly. Yes, year 2, finance cost debit to investment property. This year 2, how will you compute 1 crore plus 9,54,000? This is the interest at the end of first year multiplied by 9.5445%. Multiplied by 9.5445%. If you do this multiplication to the entire decimal, just to 2 or 4, if you do it to the entire decimals, you will get the finance cost as 10,45,049. 10,45,549. Is it okay? Please confirm if this much is okay or not. Yes, please confirm if this is okay. First year, I assume it is fine. Second year, please assume if you have taken a rounded off, there may be a difference of a few thousand rupees because the amount in crores. Okay, so don't think 1,000 rupees, 10,000 rupees difference. There has to be because the principal itself is in crores of rupees. So there would be a rounding off error. For the purposes of our understanding, please don't round off. You will get 10,45,549. Now my creditors for investment property will stand at 1 crore plus the first year's finance cost 9,54,451 plus the second year's finance cost, which is 10,45,549. So now my creditors for investment property will be 1 crore 20 lakhs. At the end of year 2, I will make the payment. Creditors for investment property 1 crore 20 lakhs to bank. Okay, 1 crore 20 lakhs to bank. Probably you know what the questions could be framed. It could be framed like payments are made on half-yearly basis. Payments are made on quarterly basis. So they could give you a question where you have purchased now. Payment is to be made after 1 year. You have to make the payment over 4 equal installments. So how would you do that? So it is essentially going to move around only with respect to computation of interest rate and the proportionate finance cost. That's it. I have explained to you for the entire year, 2 years. It could be done. The similar principles could be followed for a quarterly basis or a half yearly basis, whatever be the scenario. The important point is you have to recognize the investment property at which rate you earned it at the cash price equivalent. These two amounts are finance cost. Financing arrangement that you have entered into, and therefore you debit it to your finance cost. This will give a more faithful record. When we talk about finance cost, there is one standard that deals with borrowing cost. That standard 23. That standard tells me that the finance cost must be included in the value of your assets. The finance must be included in the value of your assets. Yes, provided it is a qualifying asset. Provided it is a qualifying asset. In this case, the property is acquired as a ready-to-use asset. Yeah, they have not mentioned it is a qualifying asset. It is a ready-to-use asset. That it is a ready-to-use asset, it is not a qualifying asset. So therefore, Ind AS 23 principles won't be applicable. You will have to take it profit and loss. You will have to take it to your statement loss as your investment property. Okay, completes that question which was there. I took the liberty of extending it a little bit so that you could get a more clear idea. Okay, let us now proceed to question number 3 of study material, which is given on page number 7.339. Is given on page number 7.339. I hope you have written this. Okay, so I rub it off. All right, next. In financial year X1, X2, expenditure in acquiring property consisting of 6 identical houses, each with including the land on which it is built. So important words, it is purchased as a single property, but there are 6 identical houses with separate legal title. So separate legal title. So go back to the principles what you studied. Is the property capable of being split? And the answer is yes. So because it is capable of, you actually have to see what means of an investment property and what would be the definition of an owner occupied property. So when this is the case, let us look at the problem. The expenditure incurred on various dates is given below. You are having purchase cost of the property. Purchase cost 1 crore lakhs. Purchase cost 1 crore 80 lakhs. Non-refundable taxes. One of the question we deducted the taxes because they were a refundable tax. They were of the nature of refundable taxes. Here they are non-refundable. You add it. It is not included in purchase, directly attributable. Legal cost related to property, it is directly attributable. So 5 lakhs, you will add it. And advertisement campaign to attract tenants. Advertisement campaign to attract tenants is not an asset. Earlier you probably may have studied a concept of deferred expenditure, but that is not at all present right now. It vanished the moment AS in the earlier regime, and here with the advent of I think Ind AS 38 intangible assets, that these kind of they are not generating any asset. So their expenses of 3 lakhs will be straight away taken to your statement of profit and loss. Opening ceremony function for starting business 1,50,000 profit and loss. So 1 lakh towards day to day will also go to your statement of profit. Value will be capitalized to read the one of the houses for office and accommodation of its few staff. Own office as well as accommodation of employees 1/6. So 1/6 will be property, plant and equipment, and 5/6 will be rented to various third parties. So this would be an investment property. How X Limited will account for the above expenses? So when you present this answer, please ensure that you don't leave it at this. Okay. There are many times when we get so happy when we see a simple question that we do all these items and present it. Advertisement, opening ceremony, and repairs and maintenance. We do not really think about it. Why? because we have not read the question properly. The question is not asking what will be the investment property value or what will be the Ind AS 16 value. The question is asking how will you account for these above expenses. So you have to give an accounting for all the 6 items which are mentioned. Now because it meets the requirement of Ind AS 16 and Ind AS 40, we apply the standards and give our answer. But this answer would be an incomplete answer because we are not addressing 3 items in that. So you have to mention below this answer that the league advertisement campaign, open ceremony costs, expenses, they would be regarded as expenses of a routine nature. So you debit it to your statement of profit and loss. Okay. Anyways, so video and audio are disturbing. Okay. So that is fine. I think I need to get the thing it is sorted out. Okay, so that's it for now. It is almost 10 o'clock. I request you all to take a break. We meet again at 11. Okay, we meet again at 11. We will be completing this standard and with the Ind AS 105. So we take a break right now and at 11. Okay. 11 to 2 will be our next session. Please go through what we have done in this. Okay, please go through what we have in this part. Okay, questions were clear. We need to do it. It won't take much time now to complete this standard. Okay, thank you. Thank you.